Welcome to Stock Talk with Nico Kritikos. Today we're going to be taking a look at Whirlpool stock, ticker WHR. This company makes several different home appliances like refrigerators, freezers, dishwashers, and a bunch of other stuff. So in the last year, this stock is down 31%, and it's currently trading at a market cap of $7 billion with a dividend yield of 5%. If we get started on my checklist, the first thing we're going to take a look at is revenue and net income. With revenue in the last 5 years, really the last 5 to 10 years, it's pretty much been flat, I would say. Last year, they did about $19.7 billion of revenue. And net income has been a little bit more volatile. And last year, they actually lost $1.5 billion. That's why the PE ratio is negative at the moment. So I would say number one, revenue increase is a no. But number two, if we look back, you can kind of see that from the 2010 to 2015 range to today, they have shown some improvement in net income. So I will give a check to that. As far as the price to earnings ratio, we're looking at about an 8 to 9 price to earnings. And this is actually pretty cheap, especially for this company. If we look at the history of their price to earnings, we're going to see that for a while it traded at about a 10 to maybe a 10 to a 20 or a 10 to a 15. And then in the last couple of years, it's been trading at between a 5 to a 12. So sitting at about an 8 today is pretty cheap, historically speaking, for this company. That will also get a check. If we look at its moat or how innovative it is, I would say yes, they are in many different industries. And in the oven and stove market, they have a 62% market share, which is very strong. So that is definitely a moat. Number 5, growing industry. Yes, I would say for all those appliances, those probably are not going to stop growing anytime soon. Maybe they have 1 year here and there where sales decrease year over year, but over the course of several years, I think it's going to jump back up. Number 6, return on invested capital. Yes, if we take a look, specifically looking at their numbers, we are going to see ROIs of 11%, 20%, 14%, 15%. So they have pretty strong numbers there. If we take a look at their equity, this is where things start to go downhill. Now, notice I put, is their equity growing without goodwill? Because I don't like counting goodwill. I think it's very deceiving, and I think it makes the balance sheet look better than it actually is a lot of times. So, and this is a good example of that, because if we go to their long-term assets, we're going to see goodwill takes up $6.5 billion, which means it's almost a, let's see, that's a little less than half, right? A little less than half of their assets are in goodwill. So that's a problem there, because if we subtract that out, now we're down to like 11,000 or no, 11 billion dollars of assets and $14 billion of liabilities, which means that's negative. If we look at, is it growing or not, we can see that assets either way have gone from 18 billion to 17 billion in the last 4 years. So that's going to get a no. Same thing here. We're looking at negative equity, so that's going to get a no. Share count decrease, yes, there's not really a problem here. As you can see, the last couple of years, they've actually done a great job. In the last 5 years, they've averaged 5% less shares on the market every year. So that is pretty strong. That's actually better than most companies. Number 10, our assets minus goodwill, 2x the liabilities. As we just saw, no, it actually turns the company negative. Profit margin over 10%. That will also get a no, because the margins are pretty small on it for this company. So last year they lost money, but typically it's 8%, 6%, 6%, 4%, somewhere in that range. So not horrible, but not good either. Cash more than average annual income. Yes, their average annual income, if we take a look, we're going to see, how I said earlier, it's about somewhere around $900 million to $1.1 billion. And if we do look at their cash, although they have a problem with their goodwill, they do have $1.9 billion of cash. So that is good enough to get a check. Number 13, a healthy dividend. Yes, their dividend is very nice right now, 5.3%. And although the payout ratio right here says negative 26%, once again, because they lost money last year, I don't think them losing money is going to turn into a consecutive thing year after year. I think they're probably going to be profitable this year and the next year. So if you go back and look at their cash flow statement, you're going to see that the money they spend on paying out dividends is not anything crazy. It's nothing that bad. We're looking at cash dividends paid about $300 million a year. Meanwhile, they're doing net income of over $1 billion. So it's anywhere from 30% to what, 15%? No, 20%, something like that. So that's going to get a check. That counts as healthy. And it is over 20 years old. So all in all, we're looking at a score of 9 out of 14, which would not be considered a buy. And before making this video, I was very eager to purchase this stock because of I love a 5% dividend. And I also love companies that have a moat like this, where they have a large market share. And it'd be very hard to take down a company like this. The only thing that I don't like about this is their balance sheet, because if we take a look back at their balance sheet, not only do I have a problem with the goodwill, but if we look at cash and debt, this is the only reason I won't buy the stock, because they're at $1.9 billion of cash, but over $7 billion of debt. So, and that, that's going to take years and years for them to pay off that debt. Just to break even on their debt, it's going to take years and years, because it's not like they're making, $2 billion a year, $3 billion a year in net income. They're doing under $1 billion. And this past year, we just saw that's why the debt went up, because they lost $1.5 billion. So that's the only reason why I won't purchase this stock. If that gets better, or that wasn't the case, I would be happy to buy this. Now, let's say you bought the stock anyways. I still think that you would probably be fine, just because of the company that it is. I think, how I said, there's not many competitors they have to worry about coming in and taking their business. I think it's a pretty solid business, selling microwaves, refrigerators, dishwashers, all that stuff. That's not going to that business is not just going to disappear anytime soon. So that's why I think you'd probably be fine anyways. You're definitely in a point of weakness when you're dealing with a balance sheet like that, where you have four times more debt than you do assets or cash. So that's a problem. That's the only reason I'm not buying the stock. If it wasn't for that, I'd buy it though. So thank you for watching. I will see you in the next video.